Okay, Jesse, welcome to Proof of Thought podcast. So glad to have you with us.
Charles, great to be here. It's been a while coming, huh?
It's been a while. It's been a while. I think we first touched base in May at Strategy World in Orlando. So glad we could finally do this.
I'm always particularly interested in seeing, the MBAs coming into Bitcoin. You and I are both at Stanford and Harvard, right?
Right, right, right.
And and I think it's a good sign that the the suits, I guess, are waking up to this is the most exciting thing going on in the world of finance.
Yeah, definitely super exciting. We might have to be a little bit careful. I think it's Peter Thiel who says, when the MBAs come in, that's usually the top. But it's just two of us for now, maybe a couple others. But
Well, only a few of us, so we're good still.
for sure. All right, well, let's get into it. This should be a lot of fun. Speaking of the past, I remember back in July 2024 in Nashville, Michael Saylor, he presented a chart that many saw as eye-opening, even game-changing, which you created. Huge. At the time, Bitcoin was a 1 trillion out of $900 trillion in global asset value. Basically, it was a speck of dust, about 0.1% of the total global asset value. BTC was around 65,000 then, and Saylor's base case projected a 29% average annual return over 21 years, reaching about 60 or 13 million per coin during that time. Fast forward a year today, Bitcoin's network value has doubled. It's a little over $2 trillion. Global asset value is about 1 quadrillion or 1,000 trillion. And Bitcoin is now 0.2% of the global asset value. So double where it was last year. Looking forward, what are your bear, base, and bull cases for Bitcoin's CAGR over the next 10 and 21 years? And don't be shy. You have a little plug and play Excel to get us the final numbers there. But curious, what's your CAGR? What do you think Bitcoin will grow at over the next 10 to 21 years?
Yeah, that's fun. I'm glad you teed it up that way, and you got all the right numbers and stuff too. That's awesome. Yeah, it was really cool to see Saylor use that. The first version of that I put out in 2023 in Bitcoin was 400 billion at that point. And was that much smaller. So it had already doubled from more than doubled by the time you saw that on stage in Nashville, and he's been using that framework. Really, the piece I put out was Bitcoin's full potential valuation, and the starting point was management consulting exercise. Okay, so if Bitcoin is digital value, how much of the world's value is in scope, right? What's the total addressable market? And I realized it's all value, right? And but then that required quantifying how much value is out there, and there wasn't like a singular view of that. So I did the management consulting exercise of trying to figure out, okay, how big are these various buckets, and what's the MEC, mutually exclusive, collectively exhaustive view of the world's value, and I ended up with that chart as the starting point for that piece, because the whole point of the thrust of that piece was, okay, from each of these buckets of value in the world, how much will Bitcoin steal, in terms of market share, siphon away, and the net result of that framework and exercise was me putting out the number of, I think that conservatively Bitcoin can reach $10 million per coin in today's terms, and that at the time, that that was only 2.5 years ago, but that felt like a wild thing to be putting out in the world then. And Saylor pretty quickly started using that same framework himself, and has and changed the assumptions a little bit, and came up with the $13 million per coin in 20 years granularity that he has, and now it's not that crazy to say Bitcoin's going to $10 million per coin. So Saylor built on top of that model. I kept it very simple, and he put together his sort of Excel model that they use internally based on that framework, based on my starting numbers, and came up with that 29% average CAGR for the next 20 years to get to $13 million per coin. But of course, not in today's dollars. That's in future dollars. That's in a world where there's 4x inflation has happened over the between now and then. But it's good marketing. $13 million per coin sounds a lot better than what would that be, $3.25 million in today's dollars. So anyway, I agree with what Saylor added to that framework and that analysis. I think the most important thing in there is that the total pie grows at 7-8% a year, which is reflects the growth of the money supply and is true inflation, in my opinion. So everything grows at that rate, and if you're growing slower than that, you're losing purchasing power relative to everything else. So like bonds can a 10-year T-bill yields 4.5%, but if you're not growing at 7%, you're losing 2.5% a year in purchasing power, and that's what's going on with over $300 trillion sitting in fixed income. So I think that Saylor was right he nailed that part of it, and then I like his approach of his analysis started with 50% a year CAGR and dropped it 2.5% a year until flatlining at 20% a year growth. And that's pretty crude, that approach to it, but it's it's roughly right. I think that to have that linear decrease and then flatline at 20% approximates what will, I think, actually happen, and so that works. And I think it's a good continuation of what we have seen over Bitcoin's 16-year history. I actually did some analysis on this sort of 6 months ago now to kind of come up with like, what do I think would be the curve of decreasing CAGR over time that better fits the data and the reality of things, and it smooths it out rather than it being pretty simple rules that Saylor used. But it amounts to the same thing. So like, go with his sort of mental model there of Bitcoin's going to keep growing at 40-ish%, 40 to 50% CAGR for the next few years, and then it'll be 30 to 40% CAGR for the next decade after that. I think that's right. In bear case, base case, bull case, I don't really think about it that way, and I probably should. I do think about it in terms of like error bars or standard deviation, something like that. So it's a probability distribution, I think, of like where Bitcoin ends up 20 years from now, let's say. It's sort of a bell curve of centered around something like $13 million a coin in those future dollar terms. It seems about right to me, and but how big that standard deviation is, I don't know. All I know is that 0.2% of the world's assets will not continue. That is the thing that everybody should. That's why I made that chart. It's the first thing you should know about Bitcoin is that it's still tiny, even though it's over $100,000 per coin, and it feels like it's over, right? It's just that there aren't many units. 21 million units of supply is tiny, and we're still extremely early in terms of Bitcoin's monetization as the store of value for the digital age.
Wow. Yeah, no, thanks for that thorough, detailed response there. And I think, yeah, for me, seeing that chart visually and just like I said, it's literally Bitcoin is a speck of dust. You have to like squint in order to see it. And so to your point, yes, we're so early. That'll lead me to our next question, but also wanted to point out that point you made about the 20%. We'll get there as well, the flatlining, around some other questions. But yeah, if anything's growing at, whether you want to use 20, 30, 40, 50%, if anything's compounding at that rate over, significant period of time, 10, 21 years, you're going to be fine if you have exposure. And so that's sort of another big idea here. But in terms of, the the size of Bitcoin relative to the global asset value, and how we were saying that's, it's such a small percentage now. How do you see Bitcoin achieving these growth rates that we're talking about? And in other words, what asset classes do you think it'll primarily take value from? Or will it just be all of them? And for context, the categories that you gave in your original analysis included gold, art, cars and collectibles, equities, real estate, bonds, and money, which I think that's like money market funds, right?
Yeah. The money bucket is really like M2 money, specifically there. Yeah. So, I think that's also part of why Saylor uses that chart. Is it is a great starting point. It's a great map for all the world's value, and then it allows you to start thinking about, okay, what is capital looking for in these different buckets? And the two big buckets on the chart are real estate and fixed income bonds. They're both over $300 trillion sitting there. And yeah, and then when you think about the sort of macro backdrop, um, we're going to have to print a lot more money. It's just the reality of having our sovereign debt levels where they are. There was a great bit of analysis during COVID, I think, Hirschman Capital, I think, that highlighted that 50 out of 51 times, I think that's the number, since 1800, that a country's debt to GDP reached 130%, they eventually soft or hard defaulted on their debt. Soft defaulting meaning they just printed a ton of money and they paid it back in nominal terms, but not in real terms. Oh, the one exception is present day Japan, which is kind of circling the drain, and I think it's sort of inevitable that they will do that. The U.S. got to 129, and then has backed off a little bit from those numbers in the last couple of years. I think down to like 126. But the structural reality is that's we're going to cross that threshold. That means we're going to soft default on our debt. That means we're going to print our way out of it. And that means that bondholders will be left, will be the losers. Bondholders will pay for, that jubilee. And people don't realize that still. Somehow the 60-40 portfolio is still the prevailing wisdom, but that is dated wisdom. That worked from 1980 to the mid 2000s. 1980 interest rates were 15, 16%. And that straight lined down basically over the next 30 years to zero. And then we had a decade at 0% interest rates. That when you have declining interest rates, financial asset valuations go up because you're discounting future cash flows less over time, and that tremendously impacts the bonds in particular, but also company valuations, because future earnings are discounted less and they matter more and they drive up valuations. So that helped, basically an entire generation. The baby boomers' entire investing careers were, centered around just ride assets that benefit from declining interest rates. And that's what they did, and real estate valuations went through the roof, because you're no longer paying a 17% mortgage. So the value of that, the cost of that can go up. The market will support that. When you have a 2% mortgage, you can afford a lot of house. When you have a 17% mortgage, you can't afford any house. Anyway, and then bonds and equities went up a ton in value because of the same dynamics. And the 60-40 portfolio worked for that generation because of the macroeconomic backdrop. And it can't work going forward because we have the exact opposite macroeconomic backdrop. Interest rates will go up because we have taken on too much debt, and the only way out is to print more. And so we will have high inflation, and interest rates will have to be higher. And actually, like, interest rates can be suppressed and held low, but true inflation is going to eat your lunch anyway. So really, what you should focus on is the growth of the money supply as your true inflation rate, which is 7-8%, and that's what Saylor captured in his model going forward. That's what you have to beat going forward. That's what bonds do not beat, right? We already highlighted that, and so I think investors are slowly waking up to the fact that the 60-40 portfolio doesn't work, and bonds are the thing in particular that don't work because they are contracts for future dollars in a time when you're actively debasing the value of a dollar because you need to debase the money in order to get out from under the debt burdens that you've taken on. So that's what we structurally face, and that's why bonds will be the big source of capital that will flow. It's going to be an exodus from, it already is, an exodus from fixed income capital from bonds. And where do you go, right? Like, actually, when you really understand it, Bitcoin's the best asset to hold. Bitcoin replaces bonds in terms of its function in a portfolio because it delivers a reliable return. It's actually quite low risk, but nobody understands that. So forget about that. That's not what people will actually be doing. But this is where Bitcoin Treasury companies come in. This is what Saylor has re-engineered strategy around, is that he has figured out that I can go to the bond market and say, I'll give you 10% a year forever. You just give me the dollars and I'll go buy Bitcoin and it'll appreciate at 29% a year for the next 20 years. And so, you're splitting the upside there basically. But with these investors, you say, I'll give you the first 10%, I'll keep the rest for my shareholders. And that's what's happening with Bitcoin Treasury companies, and I think is going to be the big story over the next 2 decades as that plays out, and these entities which are designed to tap into capital that's trapped getting not good enough returns, and you go find that capital and you offer it better returns that's powered by Bitcoin. People are going to say yes to that. You're going to win market share. You're going to ingest that TradFi capital and you're going to put it into Bitcoin. And so, that's the big story that'll play out. The big bucket is the fixed income bucket. But also, Saylor launching Stretch has been very interesting because it's the first product that taps into that money bucket, the money market in particular. And there's going to be more of that as well because all of those fiat assets aren't getting good enough returns to outpace inflation, true inflation. And Bitcoin is the solution for those investors. And Bitcoin Treasury companies are the entities that offer that solution to those investors.
Yeah. So a couple of things there, like why is anyone still holding bonds? But, the mass exodus is, that's getting started in terms of where Bitcoin will pull that capital from. Fixed income market bonds, as you described, is a major opportunity. And yeah, we just had a friend, Darius Dale, on the show from 42 Macro, and instead of the 60-40 portfolio, what he advocates for is a 60-30-10 made up of 60% equities, 30% gold, 10% Bitcoin. And that's a way of getting people, I think, a little bit more comfortable with Bitcoin, but also basically saying, hey, this old 60-40 traditional just doesn't work, and like know,
Yes.
if you've done this other mix, you've done really well and likely
It,
will continue to.
and my counter to that would be like I agree that is a much better direction to head in with your portfolio in general. Um, but at the same time, the more you learn about Bitcoin, the higher of an allocation people tend to have.
Hmm.
And so, I think the best thing that people can do is invest in Bitcoin education, learn more about Bitcoin and the whole macroeconomic context around it, because you might just find you end up with a very high allocation to Bitcoin and you end up outperforming everybody by an even bigger margin.
Yeah, no, it's a great point. And this alternative portfolio definitely isn't for the maxis. I think it's a way of getting people just more
Definitely.
comfortable with it. And like you said, typically what happens is people add Bitcoin to their portfolio. One, it just grows in size because of the outperformance of Bitcoin, but also you start to see number go up, as they say, and you're encouraged to learn more. And once you learn more about Bitcoin, you inevitably want as much of that as you can get. Personal opinion, but
Yeah. Not financial advice, but that's what happens.
right. Invest in your education yourself. But speaking of education, and someone who talks about this a lot, and as well as this would be a nice segue into the Bitcoin Treasury companies. But Warren Buffett, he famously has said that price is what you pay, and value is what you get. Many people, I think, misread NAV premiums of treasury companies as just a snapshot in time, not realizing that basically an effective treasury company can earn that premium over time, whatever they're seeing today. So in days or weeks for faster growing companies, and then sometimes in months or even a couple of years for larger ones. You've put out a really nice framework around this, price over Bitcoin yield delivered, or PBID. Can you tell us why you created this framework and how it helps investors understand Bitcoin treasury company valuations today?
Yeah, I love this topic. This is probably the most cutting edge topic that we can talk about, that for the most part even Bitcoiners aren't thinking along these lines yet. Um, yeah, when people talk about Bitcoin treasury companies, they tend to lock onto MNAV, the multiple to NAV, the premium that you have to pay. And commonly people are like, why would I pay 2x for Bitcoin? Why would I pay 5x for Bitcoin when I could just buy Bitcoin? And that's understandable, but I think the wrong sort of thought process there, because when you're investing in a Bitcoin treasury company, you're investing in my view, in a productive asset. This is an entity whose goal is to increase Bitcoin per share, and it does that by leveraging capital market tools to sort of arbitrage fiat, raise capital, buy Bitcoin in a way that's accretive to shareholders, in a way that adds Bitcoin per share. And it does that as frequently as it can. And that compounds over time. And so what it amounts to is compounding Bitcoin ownership for investors. And yes, it's in a centralized entity. It's different from your cold storage Bitcoin. It's risk capital rather than, no risk cold storage Bitcoin. But yeah, people lock onto the MNAV side of things and seem to miss that the price you should be willing to pay for a productive asset is the sticker price balanced out with how much productivity you expect to receive from that asset into the future. It's obvious to think about that in terms of any traditional real world investment you might make in commercial real estate or in a manufacturing plant or whatever. But people seem to have not yet made that leap with a Bitcoin treasury company. You're buying infrastructure that is productive. And so there's a very helpful concept of days to cover, sometimes called months to cover, that Adam Back kind of put together, or was at least the person I first saw it from. And this was like 4 months ago that this maybe 6 months ago now that this concept was introduced. but it has some flaws and some limitations. The idea there is you can, based on your current MNAV, you can look back in time to see how long ago was my Bitcoin per share equal to today's Bitcoin per share divided by today's MNAV. Right, so like a fraction. How long ago did I have a fraction of my current Bitcoin per share that amounted to me growing into my MNAV today? So it's like kind of weird to explain it already, right? Like, and some of the problem there is that you have to go back far in time. So with strategy, you need to go back like 2 years to find that point in time. And the world was pretty different 2 years ago for strategy. They didn't have preferred equities. They didn't even have Bitcoin ETFs live in the US 2 years ago. So I don't like how far back in time you have to look, and you're counting everything in that time period as relevant to your sample size going forward, which I don't love. And the other part of it is like, what does it mean to have a certain number of days to cover? It's an unconventional sort of unit to be using. And so the idea with PBYD was, let's take this concept of how long does it take to grow into your MNAV, but instead let's define the most recent period that's relevant as the period of time for our sample of Bitcoin yield delivered, and then use that amount of Bitcoin yield in that amount of time to project forward and say, how many units of time does it take to grow into our current MNAV, assuming the same rate of Bitcoin yield delivery per unit of time as our sample. And I think, and then that standardizes the output, standardizes into a number in years, which I think is more helpful. It also has the massive benefit of lining up with a PE ratio, which is, in traditional equities, people are very accustomed to paying, what's your PE ratio for buying a stock? Usually it's 20, 30, 40 PE ratio, 53 for NVIDIA. And that's what people are accustomed to. The PBYD ratio amounts to the equivalent metric. It's not using income statement earnings and multiplying that for how many years of the same amount of earnings does it take to earn back your premium. Instead, it's saying, based on the rate of value delivery through the balance sheet, how long does it take to earn back the premium you're paying? Same idea, different mechanics. And and then so that's the PBYD ratio. It's log of MNAV over number of periods in a year times log of Bitcoin yield delivered in the most recent period. And so you can set that period to be a month, a quarter, a year, whatever it is, and it all standardizes to an output in years. So I actually don't know what it is right now, but over the last 3 months, strategy tends to be like 1.5 years to earn back the premium in that stock, or less. Right now, it's probably about 1 year, and that's because they've delivered year to date 26% Bitcoin yield, and right now they're trading, I think, at like 1.5 MNAV. So because it's compounding that plus 20% every 9 months, yeah, that comes out to about a year and a half. For Metaplanet, it's somewhere between a quarter of a year and half a year. And for Smarter Web, it's the same right now. It's somewhere between a quarter of a year and a half a year. And again, this is direct comparison to 20, 30, 40 years to earn back the premium you're paying for a traditional equity. And we're talking about half a year for a well-run Bitcoin treasury company. And that's why I think that there's more value in well-run Bitcoin treasury companies than any other public equities in the world at this point in time.
Wonderful, Jesse. This is great. I think it's a great metric and a great way to look at this and analyze it. But I do want to sort of ask you some follow-up questions here. As you said, it's a very interesting topic. So we could kind of dissect this. But like we said before, none of this is combative or anything like that. We just I'll try to get more educated and better here. So I'll start off with this one. So you mentioned, with strategy, it now takes them about 1 to 1.5 years, to sort of grow into their MNAV. So let's use that as an example. If it takes 1 to 1.5 years for a treasury company to grow into their MNAV premium, do you think that could create some sort of material risk for investors? Essentially, you could argue that they're being asked to wait over a year to basically get full value for what they're paying today, during which time anything could happen. So it could be interpreted like, hey, trust us for a year, maybe a year and a half, and then we'll start to accrete some net new value for you. But of course, there's some risk in that, and investors ultimately need to be compensated for the risk that they take. Do you see this as a real risk, and how would you suggest that NAV premium skeptics think about this?
There's risk involved, and there's uncertainty with the model, and I think that's why there's such an opportunity. I think that's why there's this sort of mispricing of these equities in general, because that math is what it is, but investors collectively don't have a ton of confidence that it will continue into the future, and I think that's why MNAVs are as low as they are. And I think it's some combination of, you have to think about your mix of global investors here. The vast majority think that, why would I pay 1.5x for Bitcoin? And that's as far as they think, right? That's probably 95% or more of global investors see strategy trading at a 1.5 MNAV and think that's clearly overpriced because, I could go buy Bitcoin for cheaper. And then there's, a much smaller cohort. It's really probably 1% of investors who understand that what you're paying for is future Bitcoin yield. Yeah, and that what can inform your expectations about what that will be is how have they done in terms of executing on, delivering Bitcoin yield in the past. And that's where the sample size of the most recent period becomes instructive, but not certain, right? And so there's definitely risk going forward that maybe they were able to deliver yield up until this point in time, and then they never will again, right? And so the market has to price in that possibility. But that's also true for any, operating traditional equity. What a PE ratio is like, let's take a look at the last year of earnings and assume that we get that every year into the future. And that's a big assumption, especially when you're talking about, 20, 30, 40 years from now. They might not even be a going concern. So there is risk there, but people are so accustomed to that, and that's just how the world works, that it doesn't feel that wild to be assuming the continuation of earnings, and it does feel highly uncertain to assume the continuation of Bitcoin yield, and partly for good reason, because the reality of it is it is reflexive, it is recursive. The ability of a Bitcoin treasury company to deliver Bitcoin yield is based on, in large part, on their MNAV. So, when MNAV is going up, it becomes easier and easier for a Bitcoin treasury company to deliver yield. And when it's going down, it becomes harder and harder. And because it's a very new industry, there's a lot of, the market's still trying to figure out what to make of these things. And there's a lot of oscillation, very rapid oscillation in terms of what MNAVs the market sentiment is willing to pay in order to own a slice of these entities that are that are aiming to grow, compound Bitcoin ownership for their shareholders. So, like all of that factors in, and the market comes up with a price of what it thinks is fair at a given moment in time in terms of MNAV for these companies. But I think, to me, the lion's share of what's going on is that 95, maybe 99% of investors only see that you're overpaying for Bitcoin, and they don't see at all that you're investing in a productive entity that's delivering Bitcoin yield. And so I think that lopsidedness is why these MNAVs are so low, when the math suggests that they should be a lot higher. And you should be willing to pay a lot higher MNAV if you expect plus 26% every 9 months for strategy. I mean, their MNAV should be higher. And, for Smarter Web, we've delivered plus 278% Bitcoin yield in Q3. And, so should we be trading at 1.44 MNAV, which is what we were trading at an hour ago? That assumes that we will only ever deliver a plus 44% Bitcoin yield forever. Meanwhile, we have delivered plus 278 this quarter. So, there's risk and there's no certainty. But a well-run Bitcoin treasury company, basically a company that delivers any amount of reliable Bitcoin yield into the future, is an incredible value based on where MNAVs are and how quickly that compounding growth adds up.
Yeah, no, you're right, and I think we typically see these dynamics with new growth industries. You think about AI today, NVIDIA. Investors are willing to pay up a huge premium for the future potential earnings. Not too sure what that industry or growth will look like. You think about Cisco back in the heyday. Investors were willing to pay a lot for that too. So yeah, these dynamics seem pretty normal in terms of new growth industries. Maybe we push back a little bit on the earnings side. If I think about like subscription businesses or SaaS, a lot more predictable.
Yes.
So.
Yeah, certainly a way more predictable, way more reliable input metrics when you're valuing a traditional equity. But the different thing is that you are relying on things being the same 20 plus years from now, in many of those cases, which is that's the one thing that is more uncertain with traditional equities than with Bitcoin treasury company, that you're only looking at a 2-year time frame, and things will probably be pretty similar 18 months from now than they are versus what they are right now. But yes, point taken. There's a lot. It's different because you are trying to assess the reliability of this strategy that has different inputs and has reflexivity and some recursive variables versus the tried and true operating model.
Right. And you mentioned, right, that there, could be variance in terms of, what the yield, BTC yield might be from one quarter to the next. So those who might push back, and for investors who are thinking about sort of, is the current period the right one to use, most recent period, or should they kind of discount that in a certain way? I'm curious, what you might say to them, and maybe I could rephrase that a little bit because some of these companies, if we look at when a BTC treasury company first comes to market, their Bitcoin yield might be sky high, right?
Yeah.
If we use that, that's maybe not the appropriate metric or figure to use. And so do you think there's a way to sort of discount it in some way, especially when we're looking at new entrants to the market or companies that are in hyper growth mode? Is there sort of a better way to approximate their BTC yield in the PBYD formula?
Yeah, it's a great question. And, PBID takes a stride forward in terms of balancing the MNAV versus Bitcoin yield. Um, and, in theory, a very small Bitcoin treasury company can deliver a lot more yield and should have a much higher MNAV. The sort of tricky irony there is that, having a much higher MNAV allows them to execute better, in theory. The other sort of intangible that offsets this, I think, is like the vast majority of Bitcoin treasury companies never get their flywheel going. So there's like 200 Bitcoin treasury companies in the world, and there's probably 20 that have like a solid track record of delivering Bitcoin yield. And that's being generous, frankly. Like, I can only think of, maybe a dozen. And what that sort of implies is like the rest of them never execute enough to build a track record, like a solid track record. And that's the hidden reality, is like there's a lot of execution risk with an upstart Bitcoin treasury company. Everybody has the intention of becoming the next Metaplanet, and very few have all of the pieces that it takes to get on that path. In the UK, for example, so SmarterWeb is the first Bitcoin treasury company in the UK, and by far the leader, something like 10x larger Bitcoin stack than the next closest peer. When founder and CEO Andrew took his company public in April, that was the first Bitcoin treasury company in the UK. And then quickly, 25 companies popped up saying, we're going to be a Bitcoin treasury company in the UK, and they're going to copy the same regulatory pathways that Andrew trailblazed. And to date, 10 have bought any Bitcoin. So 15 never got to the point where, they, got through the regulatory hurdles and lined up investors and, got the infrastructure in place to actually buy Bitcoin. So right there, that shows you it's hard to execute. It's hard to get an actual Bitcoin treasury strategy in place. And a big part of that is like, can you convince investors that you have what it takes for them to invest in you? And for the vast majority, that answer is not really. 90%, something like that. And so when you talk about PBID for like a small, fast growing Bitcoin treasury company, what it doesn't account for is the intangible execution risk. And so you can be a tiny Bitcoin treasury company that owns one Bitcoin, and then you go out and you buy 2 Bitcoin the next day, and your daily Bitcoin yield is plus 200%, and you should be through the roof, valued based on PBID. But the execution risk, it says something else. So, it's not a perfect metric, but I think it is a step forward from just looking at MNAV, and also from just looking at Bitcoin yield, because you need to have both. You need to account for both to see value. And also you sort of implied in there, like, ideally you would be able to know what the Bitcoin yield will be over the future period, right? Because that's what actually is relevant to investors, is what will, if you're doing it on a quarterly basis, what's the Bitcoin yield over the next quarter? But of course that's impossible to know. So the next best thing you can do is take the most recent quarter, and maybe you modify your assumptions about whether they will be able to do that into the future. Maybe you cut it in half and use that as your input to that metric. But all we have is reality.
Yeah, no, I think that makes sense, and you kind of see that's all these companies obviously trade in a public market, and so I think that's also maybe another reason why we see a lot of this volatility and price variations and MNAVs that aren't so consistent, because I, as an investor, might have one view in terms of how much a company might grow their yield versus someone else. And so, I might be bidding at a different price than someone else. I also think here guidance could help too. I know strategy has put out some guidance as well and has typically outperformed that. And that's not really nothing new, right? Especially if we're comparing it to traditional industries. Companies put out guidance as well. Maybe they have to be careful in some ways in terms of what they're calling it because they're using non-traditional metrics and stuff. But
Yeah.
I think they've been able to at least give guidance, not necessarily like forecast.
Yeah, that's a great point. I actually haven't thought much about that, but that I think the industry will head in that direction. And then, of course, there's a lot of uncertainty about what you will actually be able to do in a given period of time. And guidance, you need to be conservative. You need to deliver on that, and so that's a whole other can of worms in terms of execution risk. But the industry will probably head in that direction.
Yeah. Yeah, no, Jesse, you're doing great here with this. Had one more on this topic to kind of get your thoughts on this. So you mentioned price to earnings, P ratio, but I'm curious, what would you say to someone who would push back and ask, how could you actually compare BTC yield to price to earnings or PE if it's not based on cash flow? And we know traditional investors, these non-Bitcoiners are very much into their cash flow and earning some sort of payment back. Which companies and maybe the reason for this, right, is that companies could theoretically pay that back to investors through dividends, through stock buybacks. As of now, I would say the consensus in the BTC Treasury company industry is that these companies won't actually sell their Bitcoin or pay back or pay Bitcoin dividends. So taking this view into account, how should we think about the comparison between earnings and Treasury company yields?
Yeah, I love that question. It's fun to think about. So what pops to mind is cash flow is what matters on a fiat standard, right? What you need to do as an investor is generate cash flows to cover your living expenses and be above inflation, right? You have to outperform inflation, and that's what everybody's chasing. And they're printing more dollars, so there's abundance, right? You can earn dollars that are being printed, and then of course Bitcoin is through the looking glass, total polar opposite world where there's scarcity. And I think that Bitcoin yield is the relevant metric on a Bitcoin standard where there's a finite amount of Bitcoin. And when you're holding Bitcoin, you're accustomed to not getting a cash flow. You don't earn any more Bitcoin. What you earn is an increase in purchasing power. Your finite amount of Bitcoin grows in its purchasing power. And that's how the Bitcoin standard works. You don't get more of it, but each unit becomes more valuable over time. And so the goal is to grow your Bitcoin ownership, to grow your purchasing power that you control in Bitcoin terms. And the way that a Bitcoin treasury company seeks to do that is by growing your Bitcoin per share, growing your Bitcoin ownership. But at no point in there does that include cash flow, right? It's just not part of the Bitcoin standard way of things, of how that monetary system works. So I guess that's what I lock onto there is dividends, cash flowing assets are a fiat solution to a fiat problem. And Bitcoin doesn't have those problems. You don't need to outpace inflation. You need to grow your purchasing power, and it doesn't require cash flow to do that.
Wow. No, Jesse, that's great. And I think probably one of the best explanations I've heard on this to kind of lay that to rest in terms of it doesn't produce any cash flow. That's not what we're going for here. It's giving you something better. It's giving you an alternative, which is increasing your purchasing power, which is power, that's strength, that's optionality, right?
Yes.
So no, I gotta do a little more thinking about that one. That's really good. Okay, so yeah, you've talked about earlier. You mentioned the importance of the fixed income market and where a lot of these pools of capital are going to come from for these Bitcoin treasury companies that ultimately get plugged into the Bitcoin network. So let's play with this idea a little bit. So, company goes ahead and sets up their preferreds. First question is like, how do they pay the yield, right? That seems to be the North Star metric for Bitcoin treasury companies right now to get preferred stock set up because of this arbitrage opportunity. So how should people think about maybe an equilibrium point, if there is one? And how do treasury companies ensure they don't end up flying too close to the sun and getting burnt? Of course, there's no debt principal that needs to be paid back with preferred stock, but there's still a yield that's owed. And if it's ever suspended, that would likely create bearish market sentiment, extending even more pressure to that situation. So, firstly, how will the yield be paid, right? And secondly, is there sort of like optimal point
Yeah.
in terms of how much preferred stock should be out there?
Yeah. Good question. It's kind of cool how it dovetails with the prior topic, because in many ways that's what a Bitcoin treasury company in end state, in the sort of preferred equity instrument era that Strategy is in, and Metaplanet's starting to evolve into. This is what a Bitcoin treasury company does in that era. They meet fiat investors where they are at, and they are the ones that offer the cash flow that the fiat investors expect. And so that's kind of the service that a Bitcoin treasury company offers. It bridges the gap between fiat investor expectations and Bitcoin reality that there is no cash flow. So that's kind of cool to think about in those terms. And so I mean, from a literal point of view, Strategy in their documents, they make a point of saying that the proceeds from selling any of their instruments can be used for working capital, and that's a catch-all bucket for we can do anything with these proceeds. And they can and will use those proceeds to pay the dividends that they owe. So it's kind of seems a little crazy, but they can print more of any of their instruments, common stock, or like how in theory they could pay dividends for Stride by printing more Stride, and using the proceeds to pay the dividends. Which sounds kind of Ponzi scheme-ish, right? But so long as you have like enough of an over collateralized balance sheet, like that's fine for that moment in time. You can't do that forever, but for that moment in time, you can. And they're going to be smartly balancing how they raise capital to pay any of these things. And of course, like they just have to service the 10% or 8%, what depending on the instrument, 10% debt when they know they use those proceeds to buy something appreciating at 30% a year. So it's already like there's volatility along the way, and you might be underwater for a little bit, but in the long run, like that's a winning proposition, and that's why they're doing it. And so they're happy to raise money however they need to service that debt, because they know it's profitable for them based on what they bought with that debt. Really interesting point in here too, though, sort of the other half of this question is, I think this is part of what, interestingly, like I think Bitcoin treasury company operators do understand this part, that people are trying to get to scale. People are trying to get as big of a Bitcoin balance sheet as they can. The pipe deals that we've seen over the last 6 months, I think, were myopically focused on that and lost sight of what, how those deals would harm the other attributes of a healthy Bitcoin treasury company, like Strategy, like Metaplanet. That you wound, you totally discard with some of these pipe deal structures. But everybody knows that you got to get to scale, and the real point of that is you want to get a big enough balance sheet. Well, the point, there's multiple points to it. You want to get to scale because you want your company to be big. So that's probably what people have been myopically focused on. But it also has this very, very important strategic benefit of you need to get to scale so that you can offer preferred equity instruments, first of all, with all the costs involved in doing those. But secondly, you need to be able to, you need to be creditworthy enough to offer them without having to offer 20% interest rates, dividend rates. Like, Smarter Web right now is 2,500 Bitcoin. If we were to go out into the market right now and say we're doing preferred equities, here's our Strife equivalent, we probably wouldn't be able to get much interest at a 10% interest rate, a 10% dividend rate. We would probably have to set it higher. I don't know how high. I don't know if that would be 12, 15, 20% before we had interest. Maybe it would be closer to, who knows? But you need to have a good enough balance sheet that's over collateralized enough that you are highly creditworthy in order for this to make sense. And that's I think what's going on. That's why Metaplanet tried to get to 30,000 Bitcoin before launching their preferred equity instruments. It all matters in terms of their creditworthiness, and that's also what Smarter Web is trying to do. We're trying to get to that kind of scale. Maybe it's 10,000, maybe it's 20, maybe it's 30,000, maybe it's more. We'll see. Bitcoin before we launch similar instruments, but you want those instruments to be a success. You want there to be demand for them, and you don't want to have to pay 20% dividend rates when you're using those proceeds to buy a volatile 29% a year CAGR asset. The volatility there might not be, it isn't really worth giving up 20% to buy that 29% asset.
Yeah, and that's the being cautious not to fly too close to the sun piece there.
Totally.
Yeah, and I love what you were saying about the different products that they have. The way I kind of think about it is like, these companies need to set up. You want a toolkit. You basically want to set up a toolkit that has a variety of options that could work in different market situations and scenarios to be able to service these yields and these payments that you have to make to continue to make this work. And I think that's what Strategy and Saylor, the team over there, has done so brilliantly, leading that charge and coming up with these things that, just a year ago, no one was really talking about preferred products. A year before that, no one was really talking about the convertible notes and things like that. But I think the important thing there is to get these set up. And, once you have these, this body of products, then you should be able to hypothetically service those yields over time. Just be careful not to set those crazy interest rates. And I think we'll circle back to that in a bit. One other thing here that's sort of emerging now, we just saw a big announcement between Strive and Semler Scientific. They recently merged. From my knowledge, this was the first Bitcoin Treasury M&A deal. Do you think we'll see a lot more of this in the coming months?
Yeah, there will definitely be a lot of this in the coming years. It's a good question. In the coming months, don't know. I think there's 90% of Bitcoin treasury companies won't really achieve a sustainable flywheel, and they will end up, the ones that have an operating business that's profitable, they'll be fine, and they'll just have their Bitcoin treasury. The ones that don't have an operating business that's profitable, they will have drag every year as they're paying their bills using Bitcoin, and that means that they will trade down to an MNAV under 1, and then they become a target for acquisition. And so we'll see, that's an opportunity for somebody else. And so we'll see those acquisitions happen, and it takes a specialized skill set that's a particular kind of team and investment thesis, going around to do that messy work of acquiring companies that are in distress and cleaning up their, cleaning house. That's a whole thing. That's like a private equity kind of skill set that most Bitcoin treasury companies don't have. Smarter Web, I don't think we really have that in the sense that, to do like a full, clean house on a underwater Bitcoin treasury company. It's messy. So yeah, but there will be, I think, dedicated shops that do this, and that'll be their thesis and their approach to adding shareholder value. So we'll see how how that evolves.
Interesting. Yeah. We recently, I was definitely shocked by that, especially with it being similar. I think they're the second company in the U.S. to start doing this. We recently had British Hodl on the show, and I was telling him how there are other companies trying to get to 1% Bitcoin, including Semler, and he was like, "Hey, I'm trying to get to 1% too." And I think it finally hit me that okay, things just aren't as they seem necessarily always. And congrats to them. I'm glad that deal went through, and it seems like it was a deal that both parties seemed happy about. I saw it come out with the team.
Sort of interesting moment in time, I think, for both sides, especially for Strive. My understanding is their MNAV is like 4.2, and they're about to have their PIPE investors unlock, which I think will mean a lot of selling as they exit to collect their discount and be on their way. And I think Strive might have thought we're about to see our MNAV compress when that happens, so we might as well use it now. And they did. Meanwhile, Semler was trading at 0.8 MNAV, and the deal I think was a 210% premium. So that puts it, 2.5 MNAV. They actually acquired them with shares at a 2.5 MNAV, even though they were trading it at 0.8. And the reason is that, I think Strive was like, well, this is how we can use our MNAV before it gets compressed. And Semler, meanwhile, was like, well, your MNAV is about to get compressed a lot, so you need to pay us a lot more than 0.8 MNAV in order for us to say yes. And so that's how they, I think, found that balance. We'll see how that deal unfolds and all the other ones in the future.
Yeah, great point on the pipe. The pipe deal there as well, and those shares coming to market soon, because I think that can help clear things up for people who are wondering, why didn't the stock Semler shoot up 210% the other day when the deal was announced? And I think some of those dynamics are at play, and that's that definitely had a lot to do with it there. I will say though, I think for me it was a bit strange because, and I'm curious to hear your thoughts on this. We just went through this stretch where there seemed to be a new Bitcoin treasury company announced every week, and plenty of Bitcoin analysts, crypto analysts were saying every corporation will end up holding Bitcoin or even becoming a Bitcoin treasury company, and that we would eventually see thousands of these. And right now I'm like, so which one is it? Do we still expect that crazy growth to continue, or are we actually heading into a phase of consolidation?
Yeah, I think both. I think things are moving really fast in this industry, and because it's brand new. And I think Metaplanet's very instructive here. They've sort of had like 4 cycles of MNAV expansion and compression, that is documented in their presentations and on their price chart over their 18 months of existence as a treasury company. And it's kind of amazing that that means they're doing a cycle every 4 months, every 3 months even, and that amounts to like Bitcoin has its 4-year cycles, and Metaplanet has had 4-month cycles. So it's like 12 times faster, because of the market having to digest all this growth really quickly. Meanwhile, the NAV floor keeps rising as a well-run Bitcoin treasury company keeps adding NAV, and it forces the market to digest things quickly because here comes the next wave of growth. So we'll see if that happens now for this sector globally going forward, or are we in for a prolonged period of digesting the growth of the first half of the year, really. I kind of bias towards the former. I think that there's been a lot of pain in a very short amount of time, and that's kind of what you'd expect for these assets. They take Bitcoin's volatility and they square it, and so that happens, and the way that manifests could either be more volatility on the price chart, or it could mean that everything happens in a compressed space of time. And it's kind of more that, I think, as we've seen with Metaplanet. So, I basically, I think we've reached the end of a bear market for Bitcoin treasury companies, even though it's only been 10 weeks. And we'll see what happens from there. There'll probably be some amount of consolidation and sideways and boring chop for a while. But the strong Bitcoin treasury companies that emerge out of this put themselves in a position for the next wave of growth. And at the same time, this sort of winter, I think, has killed a lot of these flywheels. And I think in a funny way, that's the market's way of pressure testing all the companies that said they were going to be Bitcoin treasury companies and said they were going to all get to 1% of all Bitcoin. 4 months ago, that's what everybody was saying, right? And then here comes the winter that really tests if you have what it takes to survive to the next summer, right? And maintain all the infrastructure and keep the flywheel going, keep investors excited because you still have what it takes. And most don't, won't, can't. And some will, and some will sort of continue on their growth trajectories to become, meaningful players in digital capital in their respective capital markets. I'm biased here, but I'm excited about where Smarter Web is in terms of all that. Our flywheel is still going. We are still, in pole position. We're actually, in terms of relative strength, stronger than we were 2 months ago because the smaller Bitcoin treasury companies in the UK have suffered more and their ability to raise capital has stopped, and their market cap has traded off more as a result of that. And so on a relative basis, Smarter Web is has greater market share than we did 2 months ago in the UK, in terms of Bitcoin treasury companies, and in terms of liquidity, volume traded even more, and that's really the lifeblood of a Bitcoin treasury company. So in a funny way, this winter has tested everybody, and I think the ones that survived and are still healthy will be rewarded, because they're in a position to actually grow, going forward. And maybe that's how this market goes for the next few years, of really rapid cycles of expansion and contraction, and testing the health of each of these companies every step of the way.
I think that's a really great framework in terms of level setting on expectations. I think, for people who, are invested in these companies, for this is something that's so new, after going through something like this, you could, as an investor, you could really be bewildered, especially if you're on Twitter every day, checking your accounts every day, but you got to level set those expectations. And I think there's a great framework to understand what could be actually going on here. And on a somewhat related note, in terms of new market entrants, you've talked about this a bit, but why is it necessary to have a Bitcoin treasury company in each major financial market in order to unlock pools of capital? Why can't those same pools of capital just invest in Strategy, for example, or one of Strategy's products?
Yeah, a handful of reasons. So we have the thesis that there will be a leading Bitcoin treasury company in every capital market in the world that will, we've seen that in the US with Strategy. We've seen it now with Metaplanet in Japan. we think that Smarter Web will continue on that track to be that player in the UK. We're in pole position. We just have to keep doing what we've been doing to get there. And I think that will happen in every capital market in the world because of a few reasons. There's idiosyncratic reasons, strengths and weaknesses in every, differences in every jurisdiction. In Japan, they have favorable taxation of Bitcoin for corporations versus individuals, so that's a reason to own Metaplanet instead of just Bitcoin. In the UK, to date, investors haven't had a way to get exposure to Bitcoin in with their retirement accounts, which is a huge portion of capital in the UK. And so you can go access a foreign stock, jump through a few hoops to buy strategy, or you can buy the easily accessible Smarter Web, and that's been a tailwind for us. On top of that, there's a lot of institutional capital, like pension capital as well, that has a mandate of buying domestic equities and can't touch foreign equities. So that's a big pool of capital that you have to yourself. And then on top of that, when you get to like preferred equity instruments, there are advantages to being under the same regulatory framework as the fixed income investors on the other side of the table. It helps to be regulated by the FCA if they are regulated by the FCA, and so I think that's why. Plus, there's also just the home turf advantage of retail investors in general want to support something that's from their own country, and brings pride to them as citizens of that particular nation. And in the UK too, we see how Andrew's very British story, it resonates a lot with the Brits, and he's one of them. He is a man of the people, and that matters a lot too. You can trust, you can build trust with your retail investor base domestically if you come from the same background as them, and speak in the same accent and mannerisms that they're accustomed to, and so that matters too. So there's a whole bunch of intangible but also very tangible reasons why strategy can't win everywhere, and that gives it, and Michael Saylor doesn't actually want to win everywhere. He won't say that, but the reality is this works a lot better if there are a bunch of Bitcoin treasury companies in their own respective capital markets that strengthen each other because they don't have total dominant market share, and instead we're all buying Bitcoin together, and all of it helps Bitcoin, and in turn helps each other.
Awesome. So some structural advantages, some cultural ones, and then also we have Sailor's blessing to go ahead and do this as well. So, but yeah, just thinking a little bit more broadly here, what utility does a treasury company have beyond bringing trapped capital into Bitcoin or offering higher yields than traditional finance? Maybe this is something that's comes down the line 5, 10, 15 years from now. Some people have talked about Bitcoin banks. Not too sure I fully understand that one yet, but is there any other utility that folks should be thinking about for these BTC treasury companies?
Well, I think the utility there is embedded in what you said, but these are the entities that are figuring out ways to grow the Bitcoin ownership of their shareholders. That's the mandate that shareholders have given to these entities. And so that's what they will continue to do. And, I think that evolves in the future. Like post, right now there's a lot of fiat arbitrage opportunity where there's overvalued equities, overvalued fixed income, and you're not getting great returns there. And you can, help flow capital into Bitcoin by offering them products where they get better returns. But that's only so long as Bitcoin continues to monetize. So, 50 years from now, that process is over, let's say, uh, and you've climbed the S curve of monetization, and Bitcoin has become 20 to 50% of global asset value, whereas right now it's 0.2. And in that future end state, these entities become they morph into something slightly different that is still focused on delivering Bitcoin yield. Like how do you generate value for shareholders in that end state where it's not about riding Bitcoin's growth, and instead it's about lending, or some variety of what we know as banking, right? So these, I think the way to think about it is that these are the proto banks, in that have yet to reach scale and yet to reach that end state where they become banks. But these businesses are in the business of delivering Bitcoin yield, and in whatever way makes the most sense, on a risk adjusted basis. And right now, that is very much just focusing on tapping into these trapped pools of capital and leveraging Bitcoin's growth rate. And in the future, that morphs into something else.
Got that. But when it comes to the trapped pools of capital, investors chasing yield, do you see this ever reaching a limit, or will new capital keep flowing in indefinitely through these treasury companies, the preferred products, driven by higher yields and Bitcoin's growth?
Yeah, that's where this people ask, like, how is this sustainable? How does this model work? Like, surely it stops. You can't just have a premium, MNAV. But the reality is you can, so long as Bitcoin is still monetizing. So long as it has a growth rate significantly greater than every other asset in the world, which I think will be the case for 50 years probably. Then this model does work, and that's why I think that these entities can and will end up being the preferred conduits through which TradFi capital comes to Bitcoin. And that will, if that is true, then these entities over the next few decades become the biggest companies in each of their respective capital markets. These are the balance sheets of the future, the best capitalized businesses in the digital capital era of the digital future that we're all living in, and now the money is starting to catch up to. So there's some thoughts around that topic.
Okay, no, great. And before we wrap up and head to rapid fire, wanted to close with this. It's a kind of an idea I had in mind, might be helpful for you as well in your work, but curious to hear what you think about it. It seems like there's pretty much a significant Bitcoin dip every other week, even while we're in a bull market. Would it make sense for a treasury company to sell shares when MNAV is at a premium, but wait to buy Bitcoin on more attractive entry points rather than just rushing to buy right away at a fear of the price moving up? I think theoretically, if MNAV is high during the equity sale, there should still be sort of a buffer to capture a solid spread between the equity sale and the eventual Bitcoin purchase, even if Bitcoin's price moves up a bit. But if you can catch a dip, there's almost this sort of double effect where you get this immediate accretive yield plus a quick unrealized gain if it bounces, right? And that helps to sort of keep the total holdings in profit. How do you think about these two approaches and the trade-offs between them? I know Saylor is more in the camp of, hey, I got to go buy the Bitcoin right away because the whole idea is we're capturing the gap between the premium and the price of Bitcoin, and then also, Bitcoin's price might move up, but it hasn't really been the case in practice.
Yeah, a few thoughts around this. Like, we're not actively managed fund, right? Like, it's not part of our mandate to time things. And in that sense, time in the market beats timing in the market, especially if you're trying to buy an asset that you think is going to be growing at 30% a year. You can, more often than not, if you wait, that ends up hurting you. If this grows at 30% a year, more often than not, that hurts you. And then, yes, it helps if there happens to be a dip, but if the price runs away from you in that, period of time, you're going to get hell for it. Like it's, that loss aversion concept of it hurts 10 times more when you lose than when you win. So, you're better off to, not run that risk, especially given that more often than not, you're going to lose because Bitcoin's going to run away at 30% a year. So, all those reasons combined, like, it's not our job to do that. That's for investors to do for themselves. What our mandate is from investors is to buy, add Bitcoin rather than time Bitcoin's, current exchange rate. It's just to use these capital market tools to do the fiat arbitrage playbook and add Bitcoin per share. So yeah.
Yeah, I wonder in the future if some of these companies, as part of these tools and products and a variety of offerings, will have like a trading desk or something like that. But totally hear you there in terms of the risk and the mandate from investors. Maybe if this if the premium is like 10 or something like that, that gives enough room. But like you said, you never know. And as we wrap up here, just wanted to do some rapid fire with you. I feel like you've been itching a little bit to talk about Smarter Web. So what's been the best part of working for the Smarter Web company?
Boy, that's a whole podcast right there. It's a really unique moment in capital markets history, I think, in the history of finance right here. I think this is a once in a species transition from analog value to digital value, and Bitcoin is it. And that means that every business, all capital markets will go through this digital transformation that ends up in being capitalized on Bitcoin and being part of the leading Bitcoin treasury company that's the first to do this in the UK is an unbelievably exciting thing to be a part of. Historic moment, really. And on top of that, it happens to be run by this is an awesome person who I'm thrilled to work for and work alongside. And I think our investors feel all of that. And there's a ton of excited energy about what they see unfolding in the future of this thing, and the authenticity and integrity of Andrew as our leader, as my CEO. But also on the community side, there's so many people contribute analysis and do things for free, just to help us out in terms of, like, I asked somebody for numbers yesterday, and he went and ran that analysis took probably an hour, and he just did that because he wanted to help. And I don't think that's true for many businesses. So it's a real honor to be a part of, and it's just such an exciting moment in history.
Yeah, that's definitely really unique in terms of the community and the relation between shareholders, investors, and management. Maybe you really only see that with like an Apple or Tesla. So a very unique thing there. What does success look like for Smarter Web 10 years from now?
Yeah, that looks like us having at least 210,000 Bitcoin on the balance sheet and being the leading Bitcoin treasury company in the UK and one of, if not the most valuable companies in the UK. And
Let's go world, Jesse. While we're at it.
yeah, no, we're not asking too much, right? then part of that too is like we will be well on our way to, we will look more like MicroStrategy than Smarter Web, as it exists today in terms of what we're doing to raise more capital and how we approach capital markets, meaning like preferred equities, targeting specific niches in the fixed income and money market.
Wonderful. And finally, Jesse, if 50-year-old Jesse from the future appeared in this virtual space, what do you hope he'd be able to say to you?
You were right. I've invested my whole career in this Bitcoin thesis and in this vision of digital value eating the world of value, and I've staked my whole reputation and the opportunity cost of all my time, and in many ways kind of turned my back on my Stanford MBA, and gave up all the opportunities that are open to people with degrees like ours, because I think this is the most important thing in the world. It's the thing that makes the world a better place. It moves the needle the most, and I think is also the biggest financial opportunity for anybody in the world right now. So I hope I'm right.
Well, wonderful, Jesse. This has been amazing. I hope you'll be right as well. I think you will, and I think you're blazing a trail here with what you're doing. And the humility that I see from you too, man, is I think off the charts in terms of your contribution to the space. So incredible job. Keep it up. Super inspirational. I'll definitely keep following along. I'm learning a lot from all the work that you've put out, and hopefully, this episode will help others learn a lot as well. So thanks for coming on, and a little biased here, but maybe there is something to that Stanford MBA,
Yeah. I'm excited to see what you do, Charles. I think anybody with background like ours, there's certain skills that are needed in the Bitcoin landscape, and there's a whole lot of greenfield opportunity to do stuff too. So excited to see how your Bitcoin career progresses.
Thank you. Just got to find the right one, but really appreciate that, and thanks again for taking the time.
Thank you.